So I'm going to cover a lot of subjects today and merge them into one subject or one outcome. And I think you'll enjoy the presentation. I haven't timed it, so we may run over a little bit. And I think you all are muted. If you need to talk to me, though, it's okay. You can also send questions, but I try to save them for the end. So this is about making money in volatile markets, a way to invest without taking market risk. Is there a risk in investing? And obviously there is, especially you can tell that right now. Not only is there risk that occurs when markets drop, but the risk is compounded during our retirement years. A 50% drop in the markets early in a person's retirement years can guarantee the policyholder runs out of money before they die. That's pretty amazing. And this chart shows that. And I wrote a chapter about it in a book. And this risk is called sequence of return. And while people are filtering in, I'm going to go ahead and play this video called Sequence of Returns. It's a little salesy. It was done by SetBoy, which is a bunch of salespeople. After I pointed this out to them, they did this great video. But I think it's worth listening to. So we'll go ahead and play it.
Chris, not sure if there's audio, video. Sorry, audio.
Yeah, I haven't heard any audio from the video, just see the video.
You haven't?
No.
That's interesting.
I texted you that, but.
Well, I didn't. I'm hearing all of you, and I'm trying to mute you all so I don't hear that either. Let's try this again. Interesting. It's interesting that I can hear it and you can't. All right. We're going to skip this video then. And I don't know, because I'm sitting here looking at it, trying to fix it. And it seems to be. You don't hear anything, right? Okay. We will skip it. I'll get that. I'll send you links to it. Can you hear me, though? Everybody can hear me speaking? Okay. So I'm going to go through a series of different concepts. I want to talk first about a Nobel Prize winning investment theory. There was a guy named Harry Markowitz, and in the 50s, he came up with a theory with a student of his named Professor William Sharpe on how to invest called modern portfolio theory. These professors discovered that a portfolio that was 50% stocks and 50% bonds had a higher yield than 100% bonds, but the exact same volatility or risk. Now, that's an important concept. You can raise your return and not take any more risk. They also discovered that a portfolio that was 25% stocks and 75% bonds had both a higher return than a 100% portfolio that was 100% bonds and 25% reduction in risk. So they were able to start managing for the first time the concept of risk in investing. And that when you build portfolios made up of different classes, you could raise the return and reduce risk. And that was what modern portfolio theory was about. They won Nobel Prizes, and the theory was taken up by professors at universities, and I was a finance professor myself. And it's the basis on how insurance companies, banks, and most institutions invest their own money today. Markowitz and Sharpe were both awarded Nobel Prizes in economics in 1990 for their work. Now here's a chart. This is called tactical asset allocation. This particular curve, they call it adaptive, but it's also called tactical. And the theory is now being used by Harvard and Yale for their money management. Professors at universities found that by adding judgment to the basic theory called asset allocation, meaning using your head, like what sectors to mix and how to mix them, they could increase the returns and reduce the overall risk. The theory is evolved and is now known as tactical asset allocation. Doing tactical asset allocation was almost impossible in a day when calculations were done manually or on spreadsheets. But today, we can do them with computers, and it's amazing the models that we can build. And we can mix different classes. This guy managed money at Yale University. His name is David Swensen, and he popularized this and wrote some books about this tactical asset allocation. David says, and I know him personally, he says, if it wasn't for me, Yale would have gone bankrupt. I saved them financially, and they're now one of the wealthiest endowment funds in the world using this model. Now, there are problems with asset allocation that have emerged recently. These models were originally designed with a basis of bonds. You had a portfolio made up of bonds. Then you added layers to it. You added stocks, and then international stocks and commodities and real estate and other investments like absolute return funds and hedge funds. And this became the pie everybody's familiar with on the right, called asset allocation. The problem with this is you held this model throughout all markets. So right now, interest rates are the lowest they've been in history. If they start going up, bonds are not going to probably make money because they make money when interest rates drop. And if interest rates go up, they're going to lose money. And they have a standard deviation of 12, meaning you could lose 12% a year holding a portfolio just of bonds. I don't think that's the case right now, but in the next, say, year or two, it may become a problem. So bonds are the problem. A few days ago, the 10-year Treasury bond yield dipped to 0.42%. And that's taxable at ordinary rates. Junk bonds now boast returns of 3% a year. The picture of the guy on the right is a guy named Michael Milliken. They put him on jail for making too much money, which is ridiculous. Trump just pardoned him. Michael Milliken invested in junk bonds in the 80s when the bonds were yielding 10 to 20% a year. The other problem is volatility. Now, this is a logarithmic scale, so you know this is the drop of 2000 to 2002, 2007 to 2009, and we've just had a similar drop. And what you don't see is that's 3,400 down to 2,100. That's a pretty big drop in a week. In fact, it's worse than what happened in the Great Depression. We only had 1 week worse in history. Now, there's another alternative for safe investing, and I want to talk about that. One of the safest investments in the world is whole life insurance. I was on the board of directors of the South Carolina Guarantee Association. If an insurance company got into difficulty or went bankrupt, we at the Guarantee Association redistributed the bankrupt company's assets and insurance policies to other insurance companies pro rata based on the premium sold in the state the previous year. We never had a policy that was not fully honored, and that was for over 160 years. Georgia has the same kind of Guarantee Association. So the investment is very safe. In fact, it's far safer than junk bonds and probably far safer than the average bank. There were a handful of insurance companies that failed between 2007 and 9, and I know in Georgia alone, 660 banks failed in Atlanta, Georgia. That's quite a lot, or in Georgia, the state of Georgia. So the alternative is, what is the dividend that is being paid on whole life insurance? And that's a big question. And currently, the insurance companies I work with are paying dividends of 6% a year. That's not taxable. That's like an 8%, 9% return a year before tax. And we'll talk about more of that later. Now, the next question is, how much emergency cash should an average family have? Certified financial planners, and I'm one, and I taught this at universities, and my daughter's a certified financial planner, are taught that everybody needs emergency cash. There's no hard and fast rule on how much you need, but you need enough so you don't go into debt, ever. Now, I'll make an exception on purchasing a home. But most people, this is a lot more than 6 to 10 months of income in a savings account. And I'm going to digress. I talked to a dozen CPAs, and I said, how much emergency cash do you have? Not one of them had any emergency cash. And they all said they tried it at some point and decided it was easier to use credit cards. The average family in their lifetime will pay $600,000 to $800,000 in interest over their lifetime to banks. That's before they're 70. If you include college loans, it's over 1.2 million that they're giving to the banks. And this is not mortgages. This is other interest. It's on cars, and it's built, it's everywhere. Everything we buy now has interest built into it, and it's bankrupting Americans. So can a whole life policy be used for emergency cash? And the answer is you bet. The cash value can dip as much as the first year premium. So if you think of a whole life policy, in the case on the right, there's $10,000 a year. You're putting in $10,000. It may dip $10,000 during the first 10 years. But notice by year 7, the dividend is already paid for the full cost of the insurance. And now the insurance, life insurance, is essentially free. If you design the policy right, where 40% buys life insurance and 60% goes to paid up addition, you can get a very fast growing policy in cash value. There's another kind of insurance called non-direct recognition insurance. The man on the right is Nelson Nash. He was a friend of mine. He passed away 2 years ago. He invented this concept, a very bright man. I asked him if he was a forest ranger. I asked him what his kids did. One of his sons is the medical doctor for the president of the United States. So he's no dummy. Now consider this. There are 1,000 insurance companies in America. About a fourth of them are mutual companies, meaning the policyholder receives dividends instead of it being paid to stockholders. So you want to work with a mutual company. That way you get these dividends. There are only a few companies in America. Last I counted, there were 4 out of 1,000 companies, over 1,000 companies, that are non-direct recognition. And the chances you'll ever hear about these non-recognition companies is slim and none, without Nelson Nash's discovery and him popularizing this concept along with Pamela Yellen. He wrote this book, Becoming Your Own Banker, and I was laughing when I read it because I had been CFO of 3 of the 10 largest insurance companies in Georgia and had never heard of this concept until I read his book many years later. So what is non-recognition insurance? Imagine you had $100,000 in a savings account and you're receiving 6% dividend a year. You'd be receiving $6,000 in interest income. Now, that's also fully taxable, by the way. Now, imagine you borrowed out $90,000 from this savings account, leaving $10,000. Your dividends would drop to $600 a year. In these non-direct recognition companies, when you borrow the money out, they continue to pay you $6,000 a year in dividends. Imagine that. You paid in $100, you borrowed $90 out, and they're still paying you $6,000 a year. Now, the catch that is not well taught is there is interest that they charge. Right now, they're charging 5% straight interest. When I compare that to what the banks say they're charging, that's less than 2% a year. So it's a very low interest rate, but you're effectively paying the money back to yourself. And the way you pay it back to yourself is as you're paying interest, the insurance company is receiving that money, and that's their return on investment. And you're an owner of the insurance company. So if the company is more profitable than expected, they're going to have to pay it out anyway. They're regulated. They can't keep excess profits. So in the long run, you'll get that interest back anyway. So in short, this type of whole life insurance solves several problems. Cash value is accessible at any time, so it works like a savings account. You can use this cash value to buy cars, put a roof on the house, pay for college, and help with retirement, all tax-free. So another problem, people come to me, they have $1 million in savings when they retire in a 401k. And they start taking that money out and they think, I've got $1 million. What they don't realize is now as they take it out, their Social Security is taxable. That income is taxable. And effectively, you can pretty well count on about 40% of that $1 million going to the IRS. That leaves you with $600,000. That's a lot less than $1 million. These policies are never taxable, and the death benefit is not taxable either. Pardon me. In short, this type of whole life solves several problems. It lasts as long as you live. Term insurance is like renting insurance. If you live past the duration of the term, you probably can't afford to keep the policy. That is, most people will do policy until they're 65, and when they're 66, instead of paying $2,000 a year, they're paying $30,000 a year for the same policy. Only 2% of term policies ever pay a death benefit. The cost of insurance in the policy is never more than 1 year's premium. In this example on the right, it's $10,000. That's what the cost of insurance is. I often see people are paying $30,000, $50,000, $60,000 for term insurance over their lifetime and getting nothing for it. Also, the dividends will repay them for the cost of the insurance, in this case, by the 7th year. Essentially, the insurance is free after that point. And I already said this, most people pay in excess of $30,000 a year for term insurance, and they get the money back on their whole life policy. And in this particular case, the internal rate of return was 4.36% after tax. That's like 5 or 6% before tax. And that does not include the death benefit, which is higher. So we solved several problems by simply adding a well-designed, non-direct recognition insurance policy to your savings. Yeah. You have cash that you can access at any time. So try accessing money in your 401k plan. You not only can access it, but you have to pay it back on a defined schedule. Miss a payment, and you start getting into trouble. You never have to pay back these insurance loans on any defined schedule. In fact, you don't ever have to pay them back, although I recommend it. You have life insurance that will be paid for by the dividends. Your policy grows no matter what's happening in the markets. It just keeps on growing. You have long-term care benefit built into these policies if they're done right. That can save tens of thousands of dollars of additional insurance costs over your lifetime. And we can use this as a bond equivalent, meaning you can invest in this instead of bonds and get 4.36% after tax in this case, or 6% before tax, where if you invest in bonds today, you're getting 3.5%, and it's risky. If you go to 3.5%, 4%, you're now buying really bad junk bonds and they could default on you. These insurance companies aren't going to ever default. So I believe this type of savings should be a part of everyone's portfolio. Banking Yourself was a book written by Pamela Yellen. She's actually written 3 books. She interviewed Nelson Nash, found out about it, and she's a great writer. She's a lovely person. Her books are absolutely correct. They're excellent. People worry that she's not telling the truth. And I have the highest respect for Pamela. I've known her for more than 10 years. She's a very lovely, brilliant woman, and she is extremely honest. So the best book on the subject out there is called Banking Yourself Revolution. And so I highly recommend, if you get a chance, you pick up a copy and read it. Okay. Now I'm going to go through a specific example of how to use Bank on Yourself I think you'll enjoy. This is a fun diagram. So imagine you, hold on a second. I have to minimize this a little bit. Let's assume you paid $500 for the last car you bought. Now, this is how I bought my car. And your car looked just like this, I bet. You meet with Jessica or me, and we recommend you take, once you pay off the car, you pay $500 a month only now into a Bank on Yourself program. And we say pay in for 5 years. Why 5 years? Because you buy cars, you pay $30,000 a year for cars, and you need to save up that much to buy your next car. So we're just going to use this policy just to buy cars with. That's all it's going to be used for. Okay. So it's 5 years in the future. You have $30,000 saved up, and now you borrow the money out and you walk in and you go buy a car. So now you really might want to spend more or less than that. I don't care. You might want to spend it on some other big ticket item. Doesn't matter. It's up to you. But we're just using the car as an example. So you borrow the $30,000, you go buy the car, and we know you come see me. And I say, or Jessica says, let's take that money, put it in the insurance policy. Let's not buy the car. And we know if you took $30,000, put it in a policy one time, we know that $30,000 would grow to $108,000 over the next 30 years. Guaranteed. That's what you're going to, in fact, you'll probably get more than that. Okay. Now, if you pay cash for the car, you can often negotiate 17% off the sticker price. So instead of paying 30, you might get a better deal. But we borrowed the money out. We're going to pay it back for 8 years. Now, can you get a loan for 8 years on a car? No, nobody's going to give you that. But this is your policy. You don't ever have to pay back the loan. You can pay it back on your schedule. We're going to use 5% interest. That's what they're charging right now. And we know that that's over 8 years, $6,600 in interest. We skip 2 years because you're like me. You keep the cars for 10 years, and we do it a second time and another $6,600 in interest. And we do it a third time and another $6,600 in interest. So we bought 3 cars for $30,000 over 30 years. That's $19,800 in interest. We made $108,000. So we have a profit of $88,200 remaining after buying 3 cars for $30,000. Now the cars cost us $90,000. We made a profit of $88,200. So they actually cost us $1,800 or $600 a car. Where can you buy cars for $600 a piece? All you had to do was save up that $30,000 up front one time. So that's how this works. Knowing all this, why would you buy a car any other way? Well, you wouldn't, because you now have a financial system and you should use it, and you should use the loan feature. One of the problems I have is I've gotten people to do Bank on Yourself and they never borrow from the policy. They still go use credit cards. Big mistake. You take the money out, use it, pay it back. My son uses this stuff like water. I think he's in here every month borrowing and paying it back. And why would you want to keep your money in someone else's bank? That would be stupid. The bank's giving you nothing and charging you fees. Here, you're at least getting growth on the darn thing. So you put your money in as your discretionary money in, you take it out and you use it any way you want. And that's the best way to save this. So one more thing, if you're already paying as much premium as you can, start another policy. Now here's a real life example I want to go through. Rob came to me and he's a lawyer. He was going to put in $500 a month in the policy. Now this is what he did. The bottom line, the little light blue line, he was going to pay in for 5 years, borrow out, pay it back, borrow it out, pay it back. Exact same example. $500, 3 cars, over every 10 years he'd buy a car, and what he wound up with was absolutely nothing. That flat line is zero. These are negative numbers. I said, let's put it in for 5 years in the Bank on Yourself, and this is how the policy grows. In his case, it wasn't $108,000. It grew to $215,000. Now we added 6 years to it because or 5 years to it because we had 5 years started at year 1, 5 years of growth before he used it. Now this is the Bank on Yourself model. He saves it in, takes it out, pays it back, takes it out, pays it back, and takes it out. And notice, even though he took it out and paid it back, he still winds up at the same place. If he had a savings account, I have a chart where it shows he'd wind up with maybe 80,000, not 215,000. So because it's banking yourself by paying it back that way, he comes out ahead. Now I'm going to skip this because we're having trouble reading that. But I'm going to go back to this. In short, what Rob was able to do was to save $500 a month, what he was paying on cars, buy cars, and he wound up with 215,000. The cars cost him 90,000. His profit was really closer to $160,000 just by using this policy. By the way, Rob was 48 years old when he did this policy. It works even better for my son, who was 25 when he did his. My son did a policy, $750 a month. He's going to pay in his lifetime $315,000. The policy, when he's 65, will be worth over $1 million. 20 years from now he hadn't got married and he's 30 years old, but if he gets married, the idea was he would have over $350,000 to pay for his kids' college. Now get this, this is another tangent that people don't know. If you save $300,000 for kids' college, FAFSA, when you fill out the FAFSA, they're going to look at that 300 and reduce the amount of aid you're eligible for by 5.6% a year. That's $5,600 for every $100,000 he saved a year, or close to $17,000 in reduced financial aid just because he has it in a 520. And get this, if you have it in a 529 plan, it reduces it by 5.2%. So 529 plans reduce your aid, savings accounts reduce your aid, and how much, if you make over 130,000, I think you're not going to get any aid anyway. But if you're between 60 and 130,000, you can apply for college aid. So using a banking yourself policy doesn't affect your aid at all. You get all of the aid. So when my son, if he got married and had kids 20 years from now, he'll have over $400,000, I know now, that he can access to pay for kids' college. And it will not affect financial aid at all. Now, he'll probably make over 100,000, 130,000 a year because he's a structural engineer. But if he's not making that much, if he's making 80,000, and who knows, he's going to teach at a university, he may make a lot less. Who knows what the answer is going to be? But my point is this is a great way to save. I didn't say all of your money should go into banking yourself. I said emergency cash should go in here, and you should use this as a vehicle for never, ever borrowing from a bank. This is your money that you use for your loans. And then we can do, when we do the asset allocation models, we put this in as part of your savings toward retirement. If you can't afford to do this in a 401k, at least do this. At least you're getting some growth with money you can access for emergencies. Once you've filled this up, then go to your 401k. Once you've maxed your 401k in this, then we can talk about non-qualified savings. But to me, this is the best foundation I've found out there, and very few people know about it. So that's the banking yourself story. Does this make sense to you? And does anybody have any questions? I guess that's where I'm at right now. Well, I don't hear any questions.
Well,
Go ahead.
In the presentation, you said you borrow the money to buy a car and you can pay it back or not. How can you not pay it back?
Well, the collateral is life insurance. In this world, you never buy anything without collateral. So the collateral when you buy most things is what? Real estate, right? Or cars. The collateral here is a life insurance policy. The life insurance policy always has more value. Let's go back here. I'm going to go way back. And I really didn't here we go. On the right, you see the cash value. Can you see this? So in year 10, he's paid in 100,000. He's got 110,000 in cash value and 555,000 in life insurance. So if this person borrowed let's say 50,000 out and never paid it back, he's got out here in 35 years, $1,378,000 in life insurance. He borrowed 50, maybe it grew to 100,000 with interest. He's still got plenty of money to pay for the death benefit, to pay off the debt. Does that make sense?
Yep.
Chris, one question I had. It sounded like there was some sort of match, like, or max, because you had said like just open another policy. Why would you have to do that? There's
When
upper
we
limit.
design the policies, Tom, we design them with 100% of the money going to life insurance and the max. Well, I say 100, the maximum paid up additions you can possibly pay. If you pay in more paid up additions, more higher cash value, the IRS taxes the growth.
So
Now,
what
they
is
don't
that
tax
maximum based
on
on?
the death benefit, but they'll tax the growth if you access the cash value. Does that answer your question? So to keep from mecking, they call it mecking, making it a modified endowment contract. What you need to do at that point is apply for another policy.
Well, okay, I mean, I understand the strategy point, but I didn't understand why there was a max. There's a max death benefit or
No,
what?
a max on cash value versus life insurance. So the IRS regulates how much
Oh,
cash value you can have versus death benefit. And if the cash value gets too high, they view it as an investment, not as insurance.
yeah, that's what I was trying to get at. Is that a fixed number or that's case by case or how's
It's
that?
a fixed number based on age and based on the amount of insurance. So we have to tweak it just to get as close to the MEC as possible, but not go over the MEC.
Okay, but you're not penalized if you opened a second policy then.
No, yeah. The only risk is that you open, and I'm working on my third policy. I've got 3. So I throw everything in these. I use a business's income is uneven. So Tom, you own a business and income will go up or down or up or down. When I'm really profitable, I throw everything I can into paying yourself policies. And then when I'm not and I had to do a MEC to do this. I throw it in there, then I take it out when I need the money, and then I put it back in when I have the money. And so this is just a slush fund for me. And yeah, there's some taxes, but I'd rather pay taxes and get some growth than leave it in a savings account and pay taxes and get no growth.
Okay.
Okay. Any other
Yeah,
questions?
I got another question.
Sure. Go ahead.
I'm looking at the columns in the table,
Uh-huh.
and this is a stupid question, but I got to ask it. Why does the death benefit grow to this gigantic value? I've never seen
Because
a
this
policy.
person, this was done. I pulled this off the web. This was done by someone who probably was 20 years old or 2 years old when they did it. This is like my son's policy. Most of us older people, we don't get that kind of growth because
But
the
the
cost
death,
of insurance goes up as we get older.
the death benefit is based on some formula when you start up. I'm just used to
The actuaries and insurance companies calculate this, and they're mathematicians, and they do all these calculations to determine the growth. They have to look at the profitability of their expected profitability of their insurance company, their investments, because that's how they live is off of their investments. And they have to look at their expenses, and then they determine how much insurance you're eligible for based on all those numbers.
so the market over 25 years determines your death benefit.
It really does. So what insurance companies do is as you pay premium is they take it and invest it in stocks and bonds, and mostly bonds. So right now is not a good time for insurance companies. This is where these companies really rack up money. So for Northwestern Mutual, which is a mutual company, but not a non-direct, they're direct recognition, meaning if you borrow money out of Northwestern Mutual policy, your dividend goes down, way down, just like it is in a savings account. In these companies, when you borrow the money out, your dividend does not decrease. It stays the same. The reason is they're charging you 5%. Now, they can't get 5% right now in anything but junk bonds. They're going to get 3.5%, maybe 4%, but they're getting 5% from you. That 5% makes them more profitable than Northwestern Mutual right now because you're 100%. The chances of you defaulting are none because they've got the death benefit as collateral. Whereas if they buy a bond, that bond could go belly up. You go buy a junk bond paying 5% right now, you better be looking at those financials and wondering if and when that company is going to go bankrupt. Okay? That's a very high default rate. It may be as high as 1 or 2%. So you run maybe a 2% chance of losing that money you bought bonds with. So this makes these insurance companies more profitable. Since you're an owner of the insurance company, you win. And let's give an example. Nelson Nash showed me a policy he had done 30 years before about a year before he died. He was supposed to be getting $12,000 a year in dividends. He showed me the last 8 checks he had received in quarterly dividends was over $12,000 a quarter. He was getting almost $50,000 a year instead of $12,000 a year because the insurance company was more profitable than expected. In addition, his insurance was up 30% more than they estimated. These illustrations are conservative. So and if the companies are more profitable than they always have been in the past, you can't lose. They're taking all the market risk. You aren't taking any of it. They're taking all the investment risk. You aren't taking any of it. They're taking the profitability risk. You aren't taking any of it. You're getting a good return on investment. I have a video, if I could have shown it. I'll send you all copies of the video. The return on investment on this, and one guy did, his dad bought him a policy that was not very well designed. It wasn't near a mech. The return on investment was in excess of 10% a year.
Non-taxable.
Non-taxable.
Wow.
Okay? Because you're an owner of the insurance company. And if the companies are well run, and believe me, I check them before we buy them, this is a great deal. So the problem that these companies are having, in fact, Lafayette Life is one of the companies we use, is that they're so profitable that their cash reserves are running out. So what Lafayette Life had to do was they sold themselves to Cincinnati Life. And they're now a part of Cincinnati Life owns them, but Cincinnati Life poured in hundreds of millions of dollars in reserves to keep them strong. They just grew too fast. And I was having conversations when I got involved with Banking Yourself 10 years ago. I had conversations with the president of them and said, you're going to have to sell your company if you keep this growth rate up. You can't continue to do this. You're going to go bankrupt. Bankrupt meaning they don't have the adequate reserves. So now they have adequate reserves. So this is stuff that I've researched in the background that you all don't know about. But I'm not saying do this. Pamela Yellen is saying take all your money and do this and do nothing else. I'm saying don't put all your eggs in one basket. Do this. Get the life insurance you need or long-term care you need. And particularly long-term care. You can almost not buy long-term care anymore. And it's gotten so expensive. And insurance companies are running from it because the cost of medicine is going out of sight. So long-term care, if you don't do something like this for long-term care, another 5 years, you won't be able to buy a long-term care policy. Any other questions? I think we're out of time. 12:40. We have a little more time. Or if there are no more questions, I want to thank you all for attending. It was a great, I hope you learned something, and I hope you benefited from this meeting. And we're going to try to do these at least once a month going forward. I'll also post this type of stuff on our website if you're interested in re-listening to it. Y'all have a great day.
All right. Yeah, thanks, Chris.
Thank you. Bye.
All right.
Thank you, Chris.